yesterday, so the dividend payout has been defended very strongly. But how will that go down with the investors? Today the IPO opens up. Mayuresh Joshi of Angel Broking, who's done a lot of work on the Indigo IPO, joins us now to talk about that. Mayuresh, first up, what are you recommending investors to do?
Morning, Sonia. So clearly, I think the recommendation is to subscribe at the higher end of the band. And let me put both the facts on the table, the pros and the risk factors associated with the IPO that a lot of investors need to know. So I think on the pros part, clearly I think a profitable airline, if you look at the top line, they've grown at a humongous pace over the past few years, 39.8% top line growth to be precise, 13,925 crores is what they have reported. When it comes to the bottom line, an equal strong growth exhibited there. So if I 15 numbers were around 1,296 odd crores. Having said that, Sonia, if you look at the fleet size, they've got 97, 99 odd aircraft. 22 of them are on finance lease, the rest of them are operating lease. And now I'll break down onto the expense part where they've been extremely cost effective. So if you look at the maintenance expenses, there's just 3% of their overall top line. That's because of their fleet size being relatively young compared to the others as well. So at 3.2 years compared to 4.1 for SpiceJet, which is the nearest competitor. I think SpiceJet at 12% for maintenance cost is relatively higher. When you're talking about the fleet related expenses, the profits from sale and leaseback of aircraft are set off against lease rentals. That's probably having their percentage around 17% compared to 22% for SpiceJet. And even on the operating expenses front, you're looking at fuel costs, employee costs that are quite manageable at 69.6% compared to 81-82% for SpiceJet. Having said that, I think even in terms of ATF, I think the pricing have come down, and the way we look at pricing to relate going forward as well, the prices are expected to remain at relatively low levels. So I think 41% is where we believe the ATF cost should stay for Indigo, or for most airlines for that matters. So that would also have a structural impact on how the operating margins will pan out. When it comes to the risk factors, I think 2-3 points that we probably noted down. The dividend payouts, as the management was just indicating, 3,578 crores cumulatively paid off. But again, I think the cash generated from the business is so large. And even if you look at the Q1 numbers, the profits were 640 odd crores. And that gives comfort level itself, and the management again being focused on rewarding shareholders and profitability being a very key parameter for them. The other risk factor probably is rise in crude oil prices, but again, as I mentioned earlier, with supplies from Iran starting, with the kind of supplies that are coming through in the market, from a medium-term perspective, you're not expecting any spike happening on that front. The third front obviously is the entry barriers to the business. I think very low entry barriers for the business, but again, I think any new entrant who probably tries to come in needs to have a huge amount of cash on its books to burn cash at least for the next 2 to 3 years, and I don't think any competition probably is geared up for that, specifically assuming the kind of competition that is probably hotting up even in the Indian skies. So clearly on valuation parameters as well, on EV to sales at the higher end of the band, trades at 2.1 times EV to sales, 21.3 times on a price earnings ratio, and I've done a simple comparative check with Ryanair because that's more comparable at this point of time. The Indian carriers are not making money. Ryanair again, low cost carrier, and again I think at those valuations, if I compare with Ryanair is expensive on a similar note. So I think the rationale is that it's attractively priced, it's attractively placed. The debt repayment of around 1,000 crores will also bet in aiding EBITDA margins and again interest cost reduction going forward. So subscribe at the higher end of the band, sir.
Okay, so if someone does subscribe at the higher end of the price band at 765, what could be the potential return that the shareholder could make? How much have they left on the table according to you, say in the next 1 year?
So very difficult to predict in terms of what percentage returns can be made. But again, I think if you look at the profitability numbers that the airline is posting, and if you assume that they continue with the good trend, and as I mentioned earlier as well, in Q1 they did profits around 640 crores. If you just extrapolate that over the next 4 quarters, they're going to make decent amount of money over FY16, FY17 with the kind of aircraft addition that they're going to bring in. I think the new aircrafts are much more fuel efficient. 15% cost savings happens because of fuel efficiency and the new technology. And again, I think ATF prices staying low. Our belief is that the operating margin should expand even from the 13.8% that it posted in the year gone by. So clearly, I think 10-15% to say the least, even if the IPO opens at the higher end of the band, is not ruled out for Indigo over the next 1 year.
But that is working on an assumption that crude prices continue to remain this low, right, Mayuresh? I mean, this was the same case that we saw with Jet Airways as well. When they had come out with their IPO, you know, crude prices were low, they were profit making, and since the IPO price of 1100, now look where Jet Airways is. So the fear is that this is the best time for Indigo to come out with an IPO, and the profitability may only decelerate from here. Is that a valid fear in your assumption?
So clearly, I think, as I mentioned earlier as well, from a medium-term perspective, we are not expecting crude prices to probably start drifting upwards, basically on the assumption that a lot of supply is probably hitting the markets, and that factor itself will keep the ATF prices quite low. The second assumption, again, has been the kind of control that the Indigo guys have over their operating expenses. So as I mentioned earlier as well, you look at their maintenance expenses, that is just 3% of their top line. You look at their operating or their fleet expenses, they manage that pretty well. And again, on the operating front, when you're looking at regulatory charges, the parking charges, they're quite quick in terms of turnaround. So I think they're slowly and steadily building up their fleet size. And again, I think that is a conscious effort on part of the management to consistently focus on profitability. And the growth numbers are also very evident, Sonia, over the last 4 years. So clearly, I think the fears warranted with whether Indigo will be able to perform, I think over the past 4 years, they've probably done that. In an economic situation or a financial situation where you're talking about debt going down, ATF price is expected to stay low. And again, those are assumptions, but again, these are assumptions based on certain factors that we've been seeing in the markets in terms of demand supply, of how Brent is probably coming through. But clearly, all these factors do give us hope that if they continue the good show that they've done historically, I think the results will be very, very evident in the coming quarters to come as well.
There's clearly a lot of demand for Indigo. Its anchor book at 832 crores was one of the largest, that we've seen from the Indian IPO space, and it saw a demand of 8x, according to a few reports, with 43 institutional investors and all the big names investing in it. But Mayuresh, coming to the point about the financials, in FY15 the revenue growth was 25%. FY14 the revenue growth was about 21%. Walk us through what you're forecasting in terms of Indigo's financials for FY16-17 in revenue growth as well as in margins.
So clearly, as I mentioned earlier, I think they have over the past few years grown their top line at 39.8%. And again, I think we've considerately taken somewhere between 30 to 32% over the next few years. As I said, because of the factors related to crude, and again, I think their control over their OPEX, clearly, I think the margin expansion should be very, very evident. So we're expecting at least 100 or 150 bips expansion on the EBITDA front as well. So clearly, I think 15.5% over the next 2 years on the OPM front is also not ruled out.
Would you not worry about this whole, corporate governance issue that the street has been talking about, the way their net worth went into negative just before the IPO, the kind of dividends that they've paid out when they instead could have used that to raise their, or kept their reserves in surplus high, or even paid off their debt?
So again, I think we flagged that off as an investment risk, and clearly I think the street is working on that thesis as well. But when we hear the management probably come out and say that they are quite intentful of rewarding the shareholders in the same manner, and again I think meaningfully, I think if they continue with their same policy, which we believe what we are hearing from the management, I think it will be a very, very rewarding experience for shareholders, because I think their cash flows A are extremely strong. I think B, I think looking at the kind of the trend rather in terms of how the profitability will pan out, I think the dividend ratios can work out to that high level. So I think we are not overly worried in terms of what has happened in the past. But again, I think the focus will be that their intent to reward shareholders is very much on the table. And if they continue with the same policy, I think it will be a very enriching experience for shareholders who invest into the IPO.
Okay, Mayuresh, appreciate you joining in and explaining the pros and cons and the advice on the Indigo IPO. So you should subscribe, is his view, even at the upper end, and you could see a return of maybe 10 to 15% in the next few months. Keep your eye on the mid-cap index, so that's inched back into the green.